Hello and welcome to our latest investment update as of August 14th, 2020. I'm Mark McCarron, Wescott's Chief Investment Officer. And in today's agenda, we're going to talk a little bit about the market update through today, August 14th, and the continued economic recovery, which is gathering some pace, and the forward look really to the US election coming up in November. And then finally, we'll end as usual with our current outlook. So a quick market update through today. So we've seen some positive news, particularly on the business activity side and in the service sector, which rebounded sharply both in June and July. And that's really the sector that's been most affected by the lockdowns. It's the restaurants and it's the travel and leisure, the service sector. And it's nice to see a rebound and recovery. And this is data coming from the Institute of Supply Management, PMI, which is a survey done every month. And it indicated that there's an expansion now for 2 months in a row. The other positive news is unemployment rate continues to fall, now down at 10.2%. While it's much higher than it was prior to the pandemic, which was closer to 4% or even lower. It's nice to see that it's dropping and coming down as businesses reopen. And this is coming at a time where there's still some questions and debate within Congress about continued support for the economy. The market does, in fact, expect additional fiscal stimulus to come from Congress despite the current impasse. And the market, we'll cover in a moment, the market performance so far in the second and third quarter has been strong. And this is despite the uncertainty that typically comes with a presidential election. In fact, it's coming into more focus, taking shape with Kamala Harris being named as Biden's vice presidential running mate. So we'll talk a little bit about the election impact on the markets, but first, let's just do a quick update as to where we are both on a quarter-to-date basis, which is shown in the blue bars, and the year-to-date basis, which is shown in the orange bars, for selected indexes in the US stock market. So in general, very positive news. The stock market continues to recover, up again in August, as it was in July. And quarter-to-date, it's nice to see that the rebound is a little bit more broader based. So what we're showing here is the S&P 500 up 9% on a quarter-to-date basis. That's through August 13th, yesterday's close. And if we look at the different components of that, the Russell 1000 growth, which is large cap growth companies, typically technology oriented, small cap growth companies, again, influenced by technology. Russell 1000 value, which is large cap value, which is banks and some energy companies. And then Russell 2000 value, which are small companies, more cyclical and more economically sensitive. It's the blue bars there, which show quarter-to-date performance, indicate that it's broad-based, which is really good news. However, if you look at the year-to-date numbers, which, by the way, the S&P 500 is well into positive territory, up 5.7% so far this year, it's been clearly driven by the technology-heavy growth sector, up 21.5%, one of the strongest years really for that sector over history. And yet that compares very well to the underperformance that we're seeing in the value sector of the market. Small cap value is still down close to 16%. And that's really because the economic conditions are still uncertain. However, a rebound in economic growth, both in the US and globally, should support the value side of the market. And we're anticipating that in the year to come. But let's talk a little bit about the short-term focus of the market, and that's likely to be the election. So what we're showing here on this slide is what market returns do during election years, which is the gray bar, and the return the subsequent year, the year after that election, which is the green bar. And I guess the short story is, so how to read this chart. On the left-hand side, we're showing the the different election years. So 2016, Trump versus Hillary Clinton, 2012, Obama versus Romney, 2008, Obama versus McCain. So you get the point. It's every election year, and we're looking at the return of the S&P 500 during that year. And on average, the year return is positive, up 11.3%. And so far, 2020 is many things, of course, with the pandemic, but it's also an election year. And so far, the year has a positive return associated with it. But very interestingly, I think, if you look at the year after the election year, so this would be 2021 in this case, the average return during that period is a positive 9.9%. And that's been pretty consistently positive throughout history. Yes, there are periods of time where there's negative returns. In 2008, for example, during the credit crisis, the election year where Obama and McCain were campaigning for the presidency, that was during the credit crisis, and that was a very poor year. So that's clearly it's not always positive, but in general, there's a positive return associated with that. And it's important to remember that because sometimes elections can bring uncertainty, but the market has powered through that historically. It's important to look through that history and recognize that. The other point we'd like to make with respect to elections and presidential terms is what is the annualized return during presidential terms over time. And so what we're showing on this chart is not the election year and the year after, but the full term. So what did the S&P 500 index do, for example, during the current administration, 2017 to July 31st, 2020? And its return is up 13.4% annualized. And that's including the most recent market sell-off. And if we compare that to the two Obama terms, it was up 14.3 and 14.6, so very consistent with that. And by the way, the red indicates a Republican administration, the blue a Democratic one. And you can see, hopefully from this chart, that in general, whether it's Republican or Democrat, the market has performed quite well throughout a period of a certain administration's term. And yes, there are again caveats to that. During the Bush second term, down minus 5.2%, coincided, of course, with the credit crisis in 2008 and 2009. And the Obama returns, both the first 4 years and the second 4 years, perhaps are influenced by that recovery, but also policies put in place by the president and the administration. So I think what's really important as we approach this election is that the issues that matter most for the market are going to be economic issues, trade, tax, fiscal spending. Those types of things are going to be driving market expectations further. I would add to that regulatory regime, whether it be a strong regulatory regime or status quo. And the market is going to continue to try to understand what that impact is as we get closer to November. But really, we want to finish our commentary today in terms of our economic and market outlook. We are happy to see the economic conditions are improving, and that's despite the fact that virus case counts continue to increase, albeit at a slower rate, which is great news. The rebound in the service sector activity is very encouraging, and the unemployment rate continues to fall, but remains high, and there's much more to go there. As we talked about before, market expectations associated with election outcomes tend to be already embedded in prices, and we're seeing that occur today as we approach November. And finally, as we typically do, we continue to expect and see a U-shaped economic recovery that should be reflected in a broader market. As we mentioned before, economically sensitive sectors we expect to participate more going forward. So with that, We want to thank you again for your continued trust and your confidence. Please don't hesitate to reach out to me or your advisor if you have any questions. Thank you.